So we've all seen a huge fall in energy prices, Alex, over the past month or so. What does that mean for emerging markets?
First and most obviously, there's the differential between the oil producers and the oil importers. But it goes beyond that. It's more of how do the winners win and how do the losers lose. So in emerging markets, the benefits aren't as similar or the same as they are in developed markets, in that the benefits of cheaper oil prices aren't, in most cases, directly passed on to the consumers, but instead the benefit is more on the fiscal side. In a lot of countries, they subsidize fuel prices, and so the biggest benefit has been in countries that have been able to cut their subsidies, and then they've seen a lot more fiscal space to use that money more efficiently. Frankly, it's been hugely beneficial to a lot of the emerging world, especially emerging Asia, in that they're very oil intensive. Oil imports are a big percentage of their economy, and so it has been beneficial on the current account, on the fiscal side, and inflation in a lot of countries that have high inflation. However, on the flip side, commodities have fallen in lockstep with oil in a lot of cases. And so Latin America, you're seeing a lot of countries suffer from this decline in prices, and they haven't really used the years of the commodity boom to restructure and diversify their economy. So you're seeing very much a divergence between Asia and Latin America in terms of how the benefits and drawbacks play out.
As stock pickers, we're quite struck by the scope for making non-consensus views and judgments on the world. It's interesting to us the extent to which the market has put all commodity and oil producers, particularly emerging or frontier market ones, into the same bucket and derated them all at the same pace. So we have seen some interesting opportunities, even amongst the countries and sectors you'd expect to be the most vulnerable in terms of companies which are quite well positioned, even in a lower oil price environment.
What does this do for Russia?
Well, it's been derated since 2008. So it's on one of the lowest valuations in emerging markets. It's obviously got no reform. It's now turned into a little bit of a basket case. And I think it's going to carry on being derated. And I don't think we know yet the full extent of their dollar borrowings at the company level, corporate level. Yeah. So I think actually it's one that you really need to leave alone.
Andrew, in general terms, how are you seeing the whole thing of falling energy prices?
I mean, I think we think it's unambiguously positive, really. I mean, it's positive from a global economic perspective because consumers are going to spend 2% less on oil this year than they did last year, and we think that's going to translate into about 0.5 or 1% additional GDP growth this year. And it is net beneficial to emerging markets as well. 2/3 of emerging market countries are net oil importers, not exporters. And it's only 8% of the benchmark. Now, the reason that there's been a historical correlation between oil prices and emerging markets is because the people that suffer from oil prices, the countries that suffer from oil prices, suffer twice as much as the countries that gain from oil prices. So net, there's a clear, obvious correlation. But oil-producing countries have 25% more savings than oil-importing countries do. So net, we think that's positive for emerging markets, and it's positive for global economic growth.
In those emerging markets that are oil producers, where are the warning flags about those countries which didn't do enough to diversify their economies away from what people call the curse of oil? Where are you seeing that? Or is that a factor?
I think Venezuela.
Yeah.
I mean, Venezuela is a prime candidate. Instead of retaining a lot of the reserves, the dollar receipts, they became a creditor nation and extended loans to a lot of their allies, such as Cuba, on very favourable terms. But now that the oil price has fallen dramatically, it's having serious implications for the loans that have been extended to these allied countries. And I think we're going to see some issues, particularly in Latin America, with the Venezuelans starting to call in some of these loans.
I thought the angle on Saudi was quite interesting because certainly when the oil price was coming down sharply, then we saw pronounced weakness in our Saudi consumer names, for example. So they were treated in a fairly undiscerning fashion by the market. And in fact, obviously it's a very rich country, and some of the fundamental reforms in terms of female empowerment, emerging middle class continue, and are maybe even accelerating under the new king. So it's a good example for place where fundamentals are getting better, but the valuations become sharply more attractive.
One other country we haven't mentioned is Mexico. And I think it's interesting because it is one country that did attempt to diversify its economy away from oil and energy. Unfortunately, timing didn't work out so well in terms of liberalizing its energy sector. However, they are committed to reforms, and they are, even though prices are low, they still will, I think, successfully open up the energy reforms in the energy sector. There's a lot of interest from U.S. major oil players in Mexican offshore, and they unambiguously benefit from cheap U.S. oil and gas as well. It's the one country that does benefit greatly from very cheap energy costs in the U.S. And so Mexico, although timing isn't best, they're in a good position.